a lot of top signals in this environment. The challenge, unfortunately, is just the basic fact that it can keep going. It can continue to stretch. It can continue to go until, well, we don't have enough money left to short. And this is why I continue to argue over and over again. Don't make aggressive short moves if you don't know what you're doing. If you don't know, there are classic signals. There are things that we can do with RSI and MFI, but those things are largely intraday type of shorts. And I'm going to walk you through some of that stuff today. And I am not a guy who shorts unless I have a very clear set of signals that tells me it's time. There is a man who is a master at this. His name is Jeffrey Bierman. If you want to follow Jeffrey, join us. I'm going to hang out in the room today with people who are not members. I really encourage you, be a part of our community. Join us. Follow Don 9:30. We've got everybody coming up through the market up until 2:00 today. We got Brandon, we got Blake, we got Corey, we got Gianni, we got Professor Bierman. I'm not calling him doctor, but the point here is there are so many opportunities to take advantage of this situation. And when I am looking to go the opposite way, I'm going to tell you, I'm not going to be the first guy over the wall. Don knows this. Professor Bierman knows this very, very well. I'm going to walk you through how I see the market and how I'm willing to be the second guy over the wall. So this is a very interesting environment macroeconomically, just in general. I hope you guys are having a great morning. I'm going to hop into the TheoTrade Market Masters room. If you are not in that room, well, I apologize, but I'm going to chat with Lou and Roscoe and Steven and Kramer from Toronto. Good to see you, buddy. Apex Thumbs. I know you guys, taking the time out of your day to join me this morning. I really appreciate it. Sparky, Krieg, UK Ray, and I know Erica Northport is out there somewhere floating around. Good to see you guys. This is what we're going to talk about today. We did reversal patterns yesterday. I don't know why my thing did not update, but we're just going to go through screens. Perfect. Now, you guys know you got to join us before 9:30, because if you're not joining us before 9:30 and you start looking at your portfolio at 9:30, it's too late. Remember, today, as the market opens, you are the exit liquidity if you start trying to make moves at 9:30, 9:31, 9:32. Some people like that first 15 minutes. I'm telling you right now, unless you are a pro, this is where you will get chopped up. So we're going to talk about the stocks worth engaging today. I'm going to walk you through all the different sectors. I'm going to walk you through our screens. This is going to be a theme here on Thursdays. And the reason for that is I like to look at momentum and how it's lining up on a weekly basis, not on Monday, but on Wednesday evening. And I start to dive into different things. And interestingly enough, as I said yesterday, I was shorting Apache. Some people were talking about that opportunity yesterday. Apache bombed yesterday, which was great. But interestingly enough, there still is enough support in energy right now that I have to lift that position and wait 1 or 2 days to effectively reconfirm whether or not it's time to dive back into that. This is a difficult market. So when I say whether it's a market that's safe or it's a trap day, it's going to come down to one of the strategies that we're going to talk about today and exactly where money is positioning. And that is where we start to look at the individual sectors and we start to focus on momentum and where capital is lining up ahead of tomorrow's commitment of traders report, which will tell you what the CTAs are doing. Now, I do want to point something out. I came out here to Tahoe for vacation with my family, and it was hot as could be. It was 100 degrees when we got here. And last night I went to sleep, and my family, believing that it was very hot, left all the windows open, and it is freaking cold. It's like 42 right now where I am. So I've been going from room to room, shutting the windows. I totally understand how the pioneers did not survive this. Thankfully, we have lights, we have heaters, we have refrigerators, we have ovens. It is frigid up here, and I am wearing a hoodie for a reason, Mr. George Clooney. So, from the macro side, this is probably going to be the story of the next couple of weeks. And I want you to just take in the fact that when we talk about macroeconomics, this continues to be taught by people. I love the messages that I get from Jeffrey Bierman, where he'll tell me this market doesn't make sense. It's all algorithmic. We got to start sharing some of these messages with you because it speaks to the trader's mind. We recognize how irrational this is, that the S&P 500 is trading at these incredibly irrational numbers. And if you look at this and you say, well, that we've only seen forward earnings at these levels since the 7% of the last 40 years. But the reality is, when that much capital is flowing in, and I've walked you through this before, I've said liquidity continues to expand. We're going to add another $1.5 trillion, according to cross-border capital, back into the market come through mid-2026. Where does that money go? And I don't want you to think about the S&P 500 or the Russell 2000 or anything else in terms of, oh, it's going higher. The question is, where does that money go? As I am pointing out in this second bullet, elevated valuations can stay supportive, but the market is increasingly priced for perfection. That is the random walk down Wall Street concept, the idea that the markets are rational, and they're not. What we're looking at possibly is a redux of 2021. And I go back to 2021 and just show you this chart. This is the Russell 2000. This is the perfect representation of the US economy and the idea that the markets are tied directly to the economy. Well, keep in mind, after 2020, nothing happened for the Russell. It chopped around. We had multiple negative momentum, positive momentum events for the Russell 2000. And I talk about the S&P 500 for momentum because that's where the money is, particularly passive investments, capital flowing in through ETFs, lots and lots and lots of speculation on names like Apple and Amazon and Nvidia and Tesla. But the Russell did nothing that year. Now look at the SPY. Look at what happened with the SPY back in 2021. It was a straight burn up. We had multiple tests of the 50-day moving average, but it was constantly buying the dip. Now, why does that matter? Because it was a lot of institutional money moving into the Magnificent Seven. And the Magnificent Seven, again, is the market. Now, this does not go back that far. I apologize. But let's just look at Apple stock. Look at Apple stock back in 2021. Why does this matter? Well, it matters because what exactly did Apple do that justified this level of speculation, this level of inflows, this burn upward? The answer is nothing. Their valuation increased. Their valuation stretched because they're part of this big upper band of stocks that are tied to what we call the Magnificent Seven, but more importantly, passive investment flows. Lots of capital coming in through ETFs. This stock is part of more than 500 ETFs. This is what the market has become, an instrument of valuation expansion, even in the face of what I effectively will argue, there is no logic here. And if we look at something called current market valuation, you're going to hear people say things along the lines of, This market is overvalued for all of these reasons. The price to earnings model, the price to sales model, the Buffett indicator, the interest rate model, the mean reversion model. Well, here's the mean reversion model. And effectively, what everyone will tell you is that the market should revert back to this exponential trend line. Well, I hate to break it to you, but we've been above that line for a decade. And we have to, instead of saying the market should revert back to it, really understand why we are in this environment, why this time is different. This is not the dot-com bubble. This is a bubble forged by monetary policy, treasury policy, and a consistent inflow of capital that is driving this market higher. Now, yes, there will be corrections in time. There will be these moves that are built entirely around what the Treasury Department is doing, what the Federal Reserve is doing. Everyone is obsessed in the media with the Buffett indicator. This is the stock market valuation to GDP. We should already know that post 2009, this doesn't matter. We are 2 standard deviations away from the mean historically, but I'm going to tell you right now, and I beg you to hear what I'm going to tell you. In a world where we constantly print money, the market valuation is not as important as the GDP is. I showed charts on Monday and Tuesday showing that liquidity expansion was happening and that economic activity was dropping. I talked about this yesterday. The fact that in this environment, we are seeing the economy struggle, but liquidity is expanding and the market is going higher. If you print money, if you create liquidity, if you expand leverage, the markets are going to move higher. And it is our job to figure out when those opportunities are going to go away and when those opportunities to expand are coming. And that's what I'm an expert in. And that's what I'm sharing with you every day, every morning, so that you know, hey, there's a problem on the horizon and I should get out of the way. And then I should reevaluate my opportunities. And then when that signal comes back, we buy that dip. This is very stretched. Yes, it looks horrific from a long-term perspective. But the reality is the music is still playing and the market is still dancing. And there's nothing that we can do to prevent that. So be very cautious, but understand that there is a lot of money coming into this market over the next 2 years because of Treasury policy that is likely going to take this market, S&P 500, to 7,000. And it's going to be on the back of the S&P 500. As I've noted, the SPY, I showed you what happened with the SPY back in 2021. And once again, past performance does not create future value. But the point is, the Russell did nothing. The economy, the Russell, which represents the United States economy very well, the S&P 500 burned higher because of all the money that was in the Mag 7 and all of the capital flows that moved into those very popular tech stocks. We are in that environment again. Money is looking for a place to go, and money managers do not want to make a mistake. So what they're doing and what they're going to continue to do is crowd into these names. They're going to crowd into the top 10 holdings of the SPY because if they just do that, they can come as close to their benchmark as they possibly can. The stock market is not about performance. It is about replicating your benchmark. If you are a money manager, people who give money to money managers, RIAs, say, can you outperform the S&P 500? And they'll all say yes. But then what happens is they realize that they are terrible at this. RIAs are not that great at this. And there's Plenty of studies to prove this. There are behavioral economic studies that showcase that RIAs are bad with their own money. What do I mean by that? Well, they're very good at gambling, and I'm using that term loosely, investing your money. But when it comes to their money, they actually underperform, and they need an RIA to be successful. That's a whole world of behavioral economics, behavioral finance that people don't think about. So what do? Well, they don't want to mess up and they want to keep their job. So they invest in the benchmarks. They try to replicate what is happening. And you don't make moves. This is basic behavioral finance, behavioral psychology. You don't make a move that could potentially go the wrong way. Because if they go the wrong way, if the S&P 500 goes up 10% and they're flat, they're fired. So this is where the money will continue to matriculate. And in addition to that, you will see irrationality in the valuations because of this. I just encourage you to recognize that at the end of the day, this is all about momentum. And if you just simply follow my advice, wait for the FNGD to break its 20, break its 50. And if that happens, move to cash, wait a little while. We've called this the 1% signal. And when it is time to buy back in, buy back in. Okay. All right. So in the chat with my friends, hope you guys are doing well. Good to see you this morning. Kramer said hello. Thank you. I'm going to do some things. Please do circle getting your take in it. I actually own this thing. I own Circle. And I bought it down here. But that said, down here. This obviously is a pure momentum situation right now, but long-term setup, I have said time and time again, there are these equities that are going to be protected by the financial system. I've walked through this a little bit, but the core thing here is that the companies that are in the stablecoin market are going to be buying up treasury bills. They have to. It's part of the Genius Act. Now, why does that matter? Basically, every new token that they release has to have treasury bills behind it. So, I'm not saying this yet, but this is my thesis. I have said time and time again that there is one company that I want to own over and over and over again, JP Morgan. They are the banking system. They are the financial system. However, JP Morgan is not in the business of trying to engage in banking. They are now part of the whole ecosystem that wants to engage in origination. Well, here's the thing. If this is actually what the market is going to be in the future, Circle is interesting. Circle is interesting because they may be the backstop, the new backstop of the short-term treasury bills. And what is going to maybe happen, and again, I'm not saying that this is definite, but I am looking into this. This company could actually, in the future, become systemically important. And if that is the case, if they do become systemically important, it's game on, because what is effectively being proven is that a stablecoin operator that owns short-term T-bills is going to have to remain solvent. They're going to have to remain solvent because they have to be able to buy the bills. And if that is the case, every time this thing falls, it becomes a buy the dip opportunity. This is the new financial system. Is it going to work? I don't know. But I will tell you this, for the short term, anytime that there is a massive sell-off in Circle, I am going to circle the wagons. Look at that. Little jokes in the morning. Look at me. I'm killing it. The point is that there is opportunity here to trade it. We are currently a little stretched, no doubt about that. But I want you to, again, familiarize yourself with those 20-day, 50-day moving averages and think of this company as something that may be systemically important in the future. All right. Inflation, RUT. All right. You guys are just cranking in right now. It is not we, it is they. Sure. All right. Let's dive into a couple other things that are very important. Green this morning. Yeah, we're green. And we're green because we continue to see a lot of capital in this environment flowing back into what I just described, the Mag 7. I don't know what it is about this market, but it does not want to die. It doesn't want to just fade. And this is one of those things that no matter how long you have been in this environment, and I've been doing this for 25 years, following it closely. I went through the dot-com bubble, the '08 bubble. You sit around and you'll hear people say, wow, this is very reminiscent of 2000. This is reminiscent of 2007. Yeah, and it can go on a lot longer. So this is why I'm just going to tell you, and I'm going to pull the curtain open, and I'm going to tell you, look, if the S&P 500 drops under its 20-day moving average, there may be a problem. There may be a short-term problem. A lot of algos are built around this, but as you can see, the move from the 50 to the 20 is usually common. 20 to 50, forgive me. The question is it something bigger? And as we have seen, there is no real true point in my view to try to short this market, because at the end of the day, over the 20-day moving average tells you something important. It tells you that capital is coming in. Capital is flowing in. And if you want to keep it a little bit more subjective, valuations are stretching, but capital is coming in. It takes a lot of money to flow into the system and to keep the S&P 500 above that key 20-day moving average. Now, I could change this to 19 days or 27 days, but the 20-day is what we, as a market, view as systemically important. So if we're above that level, why would you try to short it when it actually does break under that level? That becomes the time to take action. Everyone else is starting to freak out. Everyone else is starting to go the opposite direction. Panic is starting to set in. And as I'm going to show you as you go back, every single time that we break under those levels, the biggest crises of the last 5 years clearly take place under that average. But they might not come for another 3 weeks, 4 weeks, and in the case of the gilt crisis, 6 weeks. You don't have to be the first person over the wall. You don't have to be the first person to short. And if you get down to that level, think about your long-term opportunities, think about the long-term things that you've held, and question, what is the optimal way to trade this? I've said time and time again, the way that I handle this, if we get to that 20-day, what I will do, I'll look at certain things that I am willing to sell, and I will sell calls on those positions. I will look out 2 months, 3 months, 4 months, and if I own 100 shares of something, I'll sell a call 10 to 15% above where I am right now. Why? Because I am willing to sell that for 10 to 15% more than I have it right now. But if the market falls, if the market craters, the call that I am selling is going to go down in value about 90 to 95% of the time, unless it's some sort of weird thing that, may go up. Healthcare sometimes goes up in the event that technology falls. Energy might go up when technology falls. There are many different reasons for this. But my point is, I'm willing to sell 15% higher than where I am. So I will sell someone else the right, but not the obligation to purchase my shares. And if the market tanks and that call falls and I'm holding that stuff the entire time, good. I'm making money while everyone else is panicking. And then, of course, I'm looking for the market to bottom, insiders to buy, a policy shift to take place. And then all that cash that I have, I'm buying back into the things that I want to buy. Very important. We got 8 minutes. We're going to speed through this. What is strong? BAM. BAM. So Brookfield is one of my favorite companies in the world. And the reason for that is that it's structured in a different way that Berkshire Hathaway is. Berkshire has insurance companies that collects premium through their insurance company, units, and then they buy high, strong, capital efficient companies. Brookfield does something similar, but they generate it through their real estate, through their energy, through their electricity. And the article that I wrote called Over the Next 36 Months, which I'm going to put into the chat. I'm going to put it in the free room. Moderator, if you don't mind, please add this to our member room. At the core of this is the idea that you take capital that is being kicked off of all of these alternative assets, and then you invest it into capital efficient assets. Brookfield is the king of this. This is one of the best long-term names that in the event that we have big sell-offs, BAM should be at the top of your list. And the fact that they are continuing to rally off that 20 and that 50, it's telling me that this rally is not over. It's telling me it's not time to short yet. It's telling me to be patient. KKR, again, private equity, doing very, very well right now. And you have these little head fakes that transpire. KKR is another name that in the event of these big sell-offs, remember, this is a private equity administration. So KKR, when it was down at 120, I was long. I think you got another test of at least 170, possibly all-time highs. It's going to take some time. There's going to be some chop, but it is a hell of a company. CCJ, this is back in the uranium space, ongoing strong momentum strength. And what I'm just trying to show you in a chart like this is the big trends, the things that you read about on a constant basis. Maybe you read newsletters, maybe you read Barron's, and you say, all right, I like these trends for the next 15 years. Uranium, okay. When do I get in on this? Well, I assure you, there were a lot of people who read about uranium back here in December, and they bought into a company like CCJ, and it fell from 62 down to the mid 30s. And they didn't recognize that this sell-off honestly had nothing to do with CCJ. It had everything to do with broader market momentum. So those meme stocks, those theme stocks, those things that get you amped up. I've got to invest in this for the long term. Don't buy in when these things are under these moving averages. Wait for that move above the 20, above that 50, and buy in. And instead of investing in them, again, the themes that maybe you see in presentations or in stock market presentations or various things in Barron's or things that are in Market Watch, trade them, because this is going to go back down. It probably will get to 50 once again. It's not built for the long term, but it is a reminder that you should be thinking with a trader's mentality, not with an investor's mentality, when it comes to things like this that are not going to come to fruition until the mid 2040s. ARM, All of these stocks are rock solid, ripping higher. Semiconductors have been the play going back to here, May 1st. There is a difference between the 20 day moving average, which is what I trade, and the confirmation around the 50. This is strong institutional money coming back in. And we are back above that 20. I'm going to look for a retest of that 167, 170 level on ARM if we remain strong. To my Tesla fans, man, this is this tells you everything you need to know about Tesla. Lucid is a proxy. Absolute rip today. Saudis being involved in an investment, 25% move. And it's a reminder that these stocks like Lucid with very high short interest, 33%, one piece of news will drive a stock like this through the roof. And it is not over yet. It is not over yet. When this stock is short squeezed, it runs. This is one of those stocks that can absolutely make your year if you learn how to trade it the proper way. On the weak side, Uber's under some stress, Intuit under some stress, EOG. Energy stocks are struggling a little bit. And as I've noted, momentum in the energy side, it's effectively neutral right now. I am bearish right now on EMP. I just like to follow that trend. I am currently still short Apache, and I will remain short Apache. Do not follow me on this trade because this was your confirmation, not here. This was your confirmation, the 20-day, not down here in no man's land under the 20 and 50. You have to be smart. You got to be precise. If you get under that 50, that can be an opportunity. But 55 cents have already been shaved. And if you're trading short duration, just start to follow these moving averages because that's where the opportunity lies. IIF, FLXS, RYN, and WEME, they are on our watch list. They popped up. I have no idea what they do. All I know is that they are hovering around the averages that are critical, and we'll dig into some of that a little bit further today. On the sector side, energy is weakening. Tech is an issue. So you will not see this in the XLK. You're just not going to see it. The XLK looks strong, but if you start to look under the hood and you do what we do, which is you dig into the Russell, you look at the sectors, you look at tech, you look at the technicals, you move to the stocks that are down on the month, and you look at the stocks that are down 5%. "41 companies in the tech space are down 5%, down on the month. Now, why does that matter? If we go to a beta over 1, because I want to see where money is really flowing out and the things that move fast, it is a ton of software application companies. Why does this matter? What is this telling us? Well, it's telling us that the market is deeply concerned around interest rates because a lot of these companies are not profitable. They are zombie stocks. These are the ones that get beaten up first in the threat of higher interest rates. So I look at this current market. I am still a little concerned about the toppy nature, but if interest rates move higher, we have an issue. That said, last point that I'm going to make. Last point. This is what we were looking at yesterday. I've talked about the Qs, and I've talked about volume weighted average price. And if you are not a member of our mastermind on Tesla, there is still time because for what I am teaching people on how to use volume weighted average price and how to look for what we call these massive reversions down here in these deviation bands. Yesterday, there was this panic around Jerome Powell. And shortly after that, the White House denied it. These moves are monstrous. And I'm telling you right now, and I have the confirmation, I received an email from yesterday. Somebody told me that they have been using the strategy that I have been laying out in that mastermind and using scalping techniques. They made $10,000 yesterday. $10,000 simply by trading the reversions that you're seeing in front of your screen. Reversion meaning stocks popping off of certain deviation lines and moving higher. He said he made 10 grand yesterday. So this is a trader's market. Do not get distracted by the big narrative. Don't get distracted by the headlines. Focus on what is in front of you. And these types of moves that I'm constantly looking for every day. Remember, volume weighted average price is a magnet for institutions. I am looking to take advantage of moves like this. Sometimes I'm going to get it wrong. I got it wrong 2 days ago. It didn't set up. But the more that you learn and the more that you focus on this, the more opportunities are ahead. And once again, this is something that is really lining up with the work that Tony is doing. So I encourage you to join our mastermind. And I would anticipate that I will probably be doing an educational series built entirely around this in the fall. Guys, it is 9:22. I'm still on the West Coast time. Don's coming up right now. I hope you guys have a wonderful trading day. I will be back for my mastermind today at 2:30. We're going to go an hour and a half minimum, and we'll go from there. I'm going to be back on the East Coast and a little bit more cognitive. I think that's the word I'm looking for. Come Monday morning. But any questions you have, support@TheoTrade.com. Throw my name in the subject line, and we'll go from there. Guys, I hope you have a great day. I hope you got a lot out of this session. Looking forward to trading today with all of you. Take care.